Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the money world without making your brain hurt. In this video, we're diving into Putnam Dynamic Asset Allocation, Conservative Fund's latest report, which is packed with numbers that will either make you nod along or maybe even scratch your head a little. So what is the story here? It seems like this fund has been working hard to grow your money, but like any investment journey, there are ups and downs and some interesting strategies at play. Let's kick things off with a look at how things have been performing. For the 12 months that ended in September of 2025, the class of shares of this fund returned a solid 7.46%. Now, to give you some perspective, the Bloomberg US Aggregate Index, which is kind of a benchmark for bonds, only saw a 2.88% return in the same period. And even the Putnam Conservative Blended Benchmark, which is a mix of different investments, returned 7.34%. So Putnam's fund did a bit better than that benchmark too. This total return figure 7.46% for class of shares is after looking at all the gains and losses from investments, but it does not show the impact of sales charges, which are those fees you pay when you invest or sell. That is important to remember because those can add up. Let's talk about costs because nobody likes paying more than they have to. For a hypothetical investment of $10,000, the cost for class of shares came out to about $100, which is 0.96% of that investment. The report notes that this reflects fee waivers and reimbursements, meaning without those the costs would have been higher. So while $100 might not sound like a lot over time, and with larger investments, those percentages can really eat into your returns. Now let's check out Class C shares of the same fund. For the same 12-month period, they returned 6.76%. This is a little less than class of shares, likely due to different fee structures. On that same hypothetical $10,000 investment, the costs for Class C shares were $177 or 1.71%. A noticeable difference, and looking at the average annual total returns for Class C shares including sales charges, year return was 5.76%, which is quite a bit lower than the 6.76% without sales charges. This shows how those sales charges can impact your actual take-home gains. Moving on to Class P shares. These seem to have performed the best among the share classes we've looked at so far, returning 7.90% for the year. Their costs for that $10,000 hypothetical investment were only $62 or 0.60%. Lower costs often mean better returns, which makes sense. The net asset value or NAV for Class P shares at the beginning of the year was around $11.16 and it ended the year at $11.41. This might seem small, but it is the underlying worth of your investment. Now for the big picture, the total net assets for the fund across all classes stood at a massive $584,337,216 as of the 30th of September 2025. That is a lot of money being managed. The portfolio turnover rate is a pretty wild 243%. This means the fund is buying and selling a lot of its holdings within the year, which can mean more activity and potentially more trading costs. Though it could also be a strategy to adapt quickly to market changes. A really high turnover rate can sometimes indicate a more active and potentially riskier trading approach. The fund has seen some changes recently. Starting the 7th of July 2025, they started using a wholly owned subsidiary to hold commodity investments if they have any. This is a more complex way to invest, and it means their prospectus had to be updated to cover the risks associated with investing in commodities and commodity futures through this subsidiary. Also effective the 1st of November 2024, Putnam Investments Limited, a company that used to help manage the fund, merged with another Franklin Templeton company. This means new people are now involved in managing the fund's investments. Let's dive into the financials for class of shares. Looking at the year ended the 30th of September 2025 net asset value, per share started at $11.11 and ended at $11.34. That is a modest increase. The total return for class of shares was 7.46% for that year. Looking back over 5 years, it was 4.68%, and over 10 years, it was 5.04%. This shows a consistent, if not spectacular, long-term performance. The expenses for class of shares as a percentage of net assets was 0.96%. This percentage seems to have decreased slightly from previous years, which is always a good sign for investors. Now for Class C shares, their net asset value per share went from $10.92 to $11.13 in the same period. Their total return for the year was 6.76%. Over 5 years, it was 3.90%, and over 10 years, it was 4.40%. As expected, these returns are a bit lower than Class A shares. Class C expenses were higher at 1.71%, which is quite a bit more than Class A and clearly impacts the bottom line for investors. Class P shares looked really good here. Their net asset value per share moved from $11.16 to $11. $11.41. Their total return for the year was 7.90%. Over 5 years, it was 5.08%, and over 10 years, it was 5.42%. These are some of the strongest returns we've seen, and their expenses were the lowest at 0.60%. This combination of strong returns and low costs is often what investors dream of. Now let's peek at where the fund is actually investing its money. As of the 30th of September 2025, common stocks made up 58.8% of the portfolio. The top sector within common stocks was semiconductors and semiconductor equipment at a hefty 6.4%. This indicates a significant bet on that technology sector. Within that sector, Nvidia Corporation was a huge holding worth over $21 million. That is a massive chunk of the fund, clearly showing a strong conviction in Nvidia's performance. Another major holding was in the bank sector at 3.1%. Companies like Citigroup Inc. and Bank of America Corporation were among the top holdings there. The total value of common stocks held was over $343 million, with a cost of around $194 million. This means the fund has seen significant appreciation on its stock holdings. Moving to bonds, the fund had 20.1% in corporate bonds. This is a substantial portion and shows a mix of fixed income strategy. A particularly large segment was mortgage, backed securities at 16.8%. This is a pretty big allocation, and investors should understand the risks associated with this type of investment, especially given historical market events. Interestingly, the fund had negative 1.0% in TBA sell commitments, which amounts to a negative value of over $5 million. This suggests they are in a short position for certain mortgage-backed securities sold on a to-be-announced basis. This is a way they might be hedging or speculating on falling prices. The fund also uses credit default swap contracts with a total value of over $1.7 million. These are complex financial instruments used to protect against default risk or to speculate on credit quality. The fact that they have a significant unrealized appreciation from these suggests they might have made a profitable bet on credit markets this period. They also had interest rate swap contracts worth over $17,000 in appreciation, but with a significant depreciation of nearly $195,000. This indicates a strategic use of swaps to manage interest rate exposure, which seems to have had a mixed impact. Looking at the overall returns class, a shares delivered 7.46% for 1 year, 4.68% for 5 years, and 5.04% for 10 years. This is a decent long-term track record. Class P shares, however, outperformed all of these as we saw earlier. Now, this section about the trustee approval of management contracts is pretty interesting. The board of trustees, including the independent ones, reviewed the contracts with Franklin Templeton and its affiliates. They looked at fees performance competitive funds and the overall quality of services. They concluded that the fees were reasonable and that the advisory team provided high-quality investment processes. They also noted strong aggregate performance over the long term across many funds. This statistic about their rankings is key. For the 1 year period, funds ranked in the 27th percentile of their peers. For 3 years, it was the 20th percentile, 5 years the 22nd percentile, and 10 years the 20th percentile. These are generally good rankings showing the fund is performing well compared to others doing similar things. However, the report does mention some funds had disappointing performance in 2024, but the trustees are keeping an eye on that. The fund also uses brokerage commissions to acquire research services, which is a common practice known as soft dollar arrangements. The trustees are keeping an eye on this too to make sure they are getting the best price and execution for the fund. So what is the verdict? Putnam Dynamic Asset Allocation Conservative Fund seems to be a pretty solid performer for the most part, especially with its Class P shares demonstrating strong returns and competitive fees. The fund is making large bets on sectors like semiconductors and is actively managing risk through various derivative contracts like swaps and futures. While the high portfolio turnover rate and complex derivative usage might suggest higher risk, there is a clear strategy in place aimed at adapting to market conditions and seeking growth. The trustees' annual review indicates a level of oversight and a commitment to competitive fees and performance. It's a fund worth watching for those looking for a balanced approach with a tilt towards growth. What do you think about these returns and the fund's strategies? Let me know in the comments below. If you found this breakdown helpful, please give it a thumbs up and subscribe for more corporate decodes. And hey, join our Discord community linked in the description. It is a great place to discuss these filings and get more insights. Thanks for watching and see you in the next video.